Hello and welcome. This is the inaugural video interview of BasisPoint Insight, a platform for news analysis and informed opinions. Today I have with me Dhananjay Sinha, a well-known economist who navigates the crossroads of markets and macroeconomics. Dhananjay brings out interesting insights. He is a co-head of equities and head of research, strategy, and economics at Systematic Groups. The firm is into institutional brokerage. Dhananjay, great to have you. Welcome to
Thank you
this.
very much.
Today we'll be discussing the upcoming budget, what's at stake, the key expectations, and the possible market implications. Let's dive right in. Dhananjay, do you believe the budget will be able to take measures to boost consumption and internal growth?
So I think that's a right context to really ask. My straight answer is that the context of the growth and the impediments that are there. The answer is that possibly it will be an inadequate instrument to answer or redress the growth impediments that are there. So I think the underlying context has to be understood. We have seen a persistent lagging of private capex, corporate profits that were bouncing quite significantly earlier started to contract. We are also seeing in the banking sector there are issues with respect to the paucity of deposit growth and the ability of the banks to actually support growth by way of lending. There is some slowdown that is happening there as well. And of course, in the recent times, in the last 6 months, I mean the wealth effect that was being generated because of the bountiful stock market that has also undergone a significant correction with a loss of almost like 68 lakh crores of market capitalization in the last 6 months. So there are a lot of headwinds out there, and we'll need to see whether the budget will be good enough to resurrect and sort of overcome all these impediments and start stimulating growth, especially the consumption growth and household income in particular.
So, do you think that it will be a Herculean task for I mean, if one is really depending on the budget to have some miracle, do you think there are way too many headwinds at this point of time in front of the finance minister?
I think so. I would agree with that view because our view is that notwithstanding whatever the GDP numbers that we are seeing over the last 5 years, the consumption growth has been roughly about 4% on average. And if you look at the household income, it is even lesser, roughly about 3.5 to 4%. And this household income is roughly about 80% of your total GDP. And that is not really growing. And we are seeing shrinkage in the real income out there. So I think, and this is coming from both structural and cyclical factors. And hence, I would say the budget will need to have or will need to show considerable amount of imagination and shift in framework and the policy facelift for it to really trigger growth, given the context of all the issues that I've just pointed out, which are significantly structural in nature. So I would say that at this juncture, we think that the budget would follow the fiscal consolidation trajectory and glide path of consolidation that they have been adhering to for some time now. As of now, my assumption is that they will continue to remain conservative. I do not see a significant shift in stance or policy in the upcoming budget.
So, do you think that fiscal policy to that extent, because it has been contractionary and following a glide path, and the consumption demand has slowed down significantly, do you think fiscal policy has been a drag on the economic growth? And do you think you expect that to continue in the coming year as well?
So I think so because if you look at the fiscal policy framework, I think it has been significantly toward conservatism. And what we have found is that over the last 5 6 years, the whole strategy has been more on the supply side strategy, which is basically taking measures to ensure private capex happen, and there has been tax cuts, etc. There are a lot of resolution of bad loans, etc. Government budgets have actually been providing for recapitalization banks. And I think many of these, more recently, I would say recent years, they have done a lot of investments in infrastructure, etc. Post COVID, there has been almost like 27% CAGR in terms of capital spending, but yet we are not seeing private capex, emerging. So I think that framework has not really fructified into a sort of a sort of a growth trajectory that they were looking for. So I would say that uh, to counter that, they have been fairly intense with respect to tax burden on households. The spending on revenue side has been very modest. I would say if you look at the average growth this year would be, I would say overall, I would say last I would say 3 4 years, especially this year, I think the total spending has been just about 3% till November. So I think they have been curtailing the total spending, notwithstanding the huge capex that they're doing. And in totality, it is not translating into the multiplier effect that the government wanted to see. So I think as a result of it, the burden on the household has been fairly intense, and they have been facing the brunt of lower revenue expenditure, reduction in subsidy, and also higher tax burden, all of which have impacted their disposable income. So I think it's a challenging task from that standpoint. And I would say yes, the budget has been, the fiscal strategy has been fairly tight, and I think it has been a drag on the overall demand side.
Would it be fair to say that the government was following this particular trajectory in order to create enabling conditions for the corporate sector to take off with regard to their investments? First,
Of course,
cleaning up the balance sheets of banks, and then and spending so much on capex.
yes.
Uh, but then clearly the measures have not really worked in the sense that companies have not really stepped up on investments. Do you think this is the time when when the government and the finance minister will switch tactics and then focus more on revenue expenditure to boost demand?
I hope so. So I think if you look at this year IT numbers, we find that till November the overall spending growth has been about 3.5%, and there has been almost like a 12% reduction in the capital outlay, and the lending and the revenue expenditure growth has been little above 7%. So on aggregate, compared to the budgeted number for this year, which was about 8.5%, they are undershooting in terms of the pace of spending. But within this, we find that there is a sort of a trade-off that is happening, wherein the revenue expenditure are higher compared to the capital expenditure. I think the bigger issue that we find also in this whole trajectory of the fiscal math is that following the first quarter in this year, which saw a robust tax revenue expansion of over 20 25%, we have seen a significant slackening uh, after the first quarter. So July to November, there has been a contraction in corporate tax collection. There's considerable moderation in income tax, and some moderation in the indirect tax as well. So I think this is also a year when RBI gave significant dividend to the government. So I think what we are finding is that there is a sort of a moderation as far as the as far as tax revenue is concerned. Non-tax revenues have been stagnant. Disinvestment has been very modest or negligible. So I think there is a significant trade-off. So I think they are trying to rebalance it in the budget. I would assume that there will be a considerable undershooting versus the 11.11 lakh crores of capital allocation that they had budgeted for, and there could be relatively better spending on the revenue side, revenue expenditure side. I would assume that would be the trajectory when going forward in the in the upcoming budget. They're expecting about 6 to 7% overall spending growth, and they are expecting that the mix of the spending will be veering more towards the revenue expenditure. And we think that on the capital outlay, if you look at historical trajectory, it does look to be a case where the overall capital expenditure as percentage of total may have peaked out, and it might actually moderate for several years to come. So I think we are expecting a shift in the mix in the overall spending pattern, and that can last for several years. And I would say the problem is also because you will have moderation in tax collections as well. You have maxed out in terms of the incidence of tax on household, which needs to be reduced in the coming years. So it's an interesting setup. We'll see how this pans out, and whether the fiscal policies can stimulate demand side or stimulate growth or not.
So, in fact, let me latch on to that last part you made. Do you think increased revenue expenditure, especially if you look at a bulk of the expenditure has happened in the form of fertilizer subsidies and other subsidies? Do you think just a switch in the composition of the expenditure will be enough to boost growth in the current in the coming year and the next 2 years?
So I think it may not be actually. See, the thing is, we have to understand that the government may not. So the assumption that I have is that the government may not abandon the fiscal glide path, which means the total spending growth will actually remain much lesser than the nominal GDP growth that they would assume. So they typically assume 10.5% growth. I think this year first half it has come down below 9%, and it is possible that it may moderate even further. And if you look at the total spending growth over the last couple of years, 2 or 3 years, it has been less than the nominal GDP growth, which means there has been a drag as far as total spending is concerned. And on top of that, if you look at the tax incidence, which has been fairly robust, it is largely led by better compliance, and the formal sector contributing more, and the incidence of indirect taxes been higher and subsidies been lower. So if you look at that, so the overall spending, which is less than the spending growth, which is less than the nominal GDP growth, and also the fact that tax incidence is higher, it has cumulatively been a drag on the overall demand side. So I think that's an important thing to really look at. And what we also expect, or at least that we are seeing, that private capex has not happened. So this whole spending on infrastructure, etc., that the government has done, huge capex that it has not translated into the supply side bounties that should happen. So the multiplier effect has not happened. As a result, corporate capex has been lower, corporate sales growth has been slowing, and as a result, compensation in the formal sector would also slow. So I think you have a very tough scenario where you need to have a consolidation on the fiscal side, and corporates may not be very enthusiastic about uh, uh, capex or hiring people or spending on compensation. So you have this cyclical slowdown around a structurally low growth. I think that is the thing, and we'll have to see whether what government does. I think they will need to think beyond the budget also, and for successive years they will need to implement some long term policies.
What could those be in your opinion?
So I think you might need to abandon the fiscal consolidation to some extent. You may not may need to be a little liberal on the fiscal consolidation. I'm not saying you need to go, but you need to be more liberal, and you need to be less conservative on that. Uh, Secondly, I would say that uh, in terms of overall structure, this our policy has been largely supply side driven. With the assumption that the supply side impetus can actually translate into private capex and employment generation. I think that needs to shift. So you need to focus a lot on employment generation. You need to work at a micro level with the state governments and the central government together should actually come up with plans to proliferate employment generation, especially in services space. I mean, we think there are a lot of low hanging fruit in the services space, which includes health services, tourism, logistics, and such services sector, which has got employment elasticity, which is higher than one. Whereas we see that due to automation and digitization, there is a lot of consolidation that is happening in the formal sector. So employment elasticity is actually decreasing, and we see that there is a, I mean, the study done by Economic Advisory Council of the Prime Minister, they have come up with a study on the migration. We are seeing that there is a contraction in migration out there, which means there is more and more ruralization that is happening. And the PLFS survey data also shows that the percentage of people who are relying on agriculture is rising. It's risen to about 46%, which means the productivity of labor and the productivity of economy is actually slackening. So you need to, go down to that level, create encourage small firms, small industries. MSME sector has to be encouraged. Actually, we need to have a lot of involvement in this whole strategy along with the state government. So I think there has to be a very concerted framework of strategy to address the structural issues. I need to step down from this whole approach of encouraging national champions in large companies.
Do you think this migration has slowed down? Is it because of the wage effect that urban areas, the wages have not really gone up? Is that the reason why the migration from rural areas is actually slowed down?
Yeah, I think so. See, the thing is, as I said, the formal sector has actually been able to adopt more technology. There's a lot of capital deepening that has happened because of digitization and such things and automation. As a result of which the employment elasticity is falling furthermore, and as a result of that, there is the urban areas are not able to uh, hold on to the unorganized or informal workers. So the cost of living in the urban area has been rising. In general, the inflation has been much higher than what is seen as printed inflation, and that has actually discouraged people, or the incentive for people to migrate from rural to urban is actually diminished. And and uh, and simultaneously, we are seeing that the government has been providing free food post COVID, and that has become a common sort of a enduring feature. So basically, the incentive for and the cost and benefit analysis, if workers are doing, they're better off staying in the rural areas. So I think that is actually translating also into disguised unemployment in the agriculture sector. We have seen the NABARD report, which basically tells us that within the agriculture sector, people are relying on the non-core agriculture activities within the agriculture households as well. So I think that pressure of earnings is fairly pervasive. It is not just in urban areas; it is also there in rural areas. I think the reduction in migration also implies that if the workforce is growing at 1.8% CAGR in the rural areas, because of the reversal of migration, it could be closer to 2%. So I think the pressure on wages is very high. I would say stagnancy is there. Real wages must be is contracting, and it is actually pushing a lot of participation in the disguised unemployment within the rural areas. So I think it's a structural problem, beyond just beyond the means of the union budget to address.
So, in the context of growth, which is the first line of defense in terms of addressing the slowdown of economy? Is it the fiscal policy or is the monetary policy at this stage, which has to do the heavy lifting in that sense?
So I think the bigger role has to be played by the fiscal policy. I think when we look at the fiscal and monetary policy, we typically see it as a counter cyclical intervention. Typically, when the growth slowdown happens, there is an expansionary approach both the fiscal and monetary policy adopt. When we address this whole thing academically. Likewise, when there is a buoyancy, they need to sort of normalize. I would say uh, what we are facing today is a combination of a structurally low growth. I mean, that is reflecting in the household situation, which is 80%, as I said, of the total GDP, which is not growing. And I think what we see as a headline growth has been largely led by large expansion of government spending on capex, whereas there has been a drag on the overall household because of higher tax incidence and lower revenue spending, curtailment in subsidy, etc. Um, I would say that monetary policy will have very little role to play at this juncture. Because of this, because monetary policy is largely a counter cyclical instrument, and it works well for a in a scenario where there is a steady state growth trajectory on average. But if the structural growth is actually coming off, the monetary policy has very little role to play. Practically, in the current context, we are seeing that the banking system, which RBI has an influence over, and through which the monetary policy actions are transmitted, the credit deposit ratio for the banking system is at a 30-40 years high at 80%. And since the household income has not been growing, there's been a contraction, I would say, in real terms at a broader level. The savings has been lagging, and the deposit accretion has been lagging as well. So you need to have a normalization of the CD ratio, and we have seen a significant, I would say, non-collateralized lending that banks have done, and the households have actually taken it because of the lack of income supporting their expenditure. So as a result of that, there has to be a normalization, and in that context, we are seeing that banks are facing a lot of credit liquidity crunch. We are seeing that they are depending a lot on non-deposit liabilities to fund retail lending. There are a lot of structural mismatches that are there. So I think the ability of the RBI to resurrect growth in that context is very little. And I would say accommodative actions can be futile at this juncture.
So to that extent, do you think the RBI will defer a rate cut, or do you think they will, in solidarity and to some extent, uh, not be counter cyclical, they would cut interest rates in February?
So I think if you look at it, a lot of people think that RBI are expecting that a lot of people who are hoping for a rate cut. First of all, whether it there are two issues out here: whether it has the potency to create a rebound, a sustainable rebound without creating inflationary pressure or depreciation currency. That is one aspect to really look at. The other aspect is to really consider whether it will sustain or not in the context where you want to limit the uh, or restrain the non-collateralized lending and improve deposit, and CD ratio has to fall. Whether it helps in that, my answer is no. Third thing to really look at is in the context where the RBI has followed a very rigid exchange rate policies, and my estimate shows that over the last 2 years the rupee has behaved more like a peg, you know, relative to the dollar. And we are also seeing that, on the contrary, yuan has actually been more flexible, which was earlier supposed to be more rigid. So I think because of this, you need to allow more of depreciation in the currency with a stronger dollar that's been there. And in that context, if you sort of uh, become more accommodative and all, it can actually translate into a much higher volatility as far as the currency is concerned. So I think RBI will need to give more time, allow the banking system to adjust to a normalization. There has to be a normalization as far as lending is concerned. They should allow the deposit growth to improve. They should allow currency to find a path, find a sort of fundamental value which is stable, which we think is around 90-92 levels for the current simulations that we've done. So I think those things need to happen, and then possibly they can cut rates as well. So I would say that they need to manage liquidity, steer the banking system to an equilibrium. Currently, the banking system is in disequilibrium. So I would say that all those things need to happen. And as I said, on top of everything, it is a counter cyclical tool. It is not something that will be very effective in the context of a lower structural growth, which is still too. So the equilibrium still is little light of us.
I have a two-part question with regard to what RBI can do.
Yes.
First part is what you mentioned about banks need to normalize the trade deposit ratios. To that extent, will there be a policy trigger? And second, the liquidity measures that the RBI just announced, is it signaling some liquidity adjustment only and not really some sort of an easing stance? How would you characterize these measures?
So I would say that I didn't get the first part of the question, but I answered the second one. So if you look at last 8.5 years, I would say for 80% of the fortnights that we have seen, the liquidity in the banking system has been in surplus, right? I would say till recently also it was neutral. It was not really tight, despite the fact that RBI had increased rates and stuff in the recent cycle. They had actually been the liquidity has been easy. It's not been very tight. I would say the tightness has started to happen more recently. I would say that that is largely because the RBI had actually has been intervening in the currency market more aggressively, and the dollar has been strengthening, and because of which they had to sell dollars of roughly about $77 billion, and that translated into tightening liquidity. The structural context is that you had a low growth in the deposit growth of banks, and the credit growth was aligning, but still higher than the deposit growth. So the moment you start intervening, it translates into a very intense liquidity tightening also. So the thing is, what RBI seem to be doing now is to compensate that by CRR cut and the OMOs that they have done. So I read that the liquidity deficit rose to almost like 3.5 lakhs recently, which is a 15-year high, which means the intervention in the currency market has continued. So what they are trying to do is to compensate that by reducing CRR and also doing an OMO, which basically replaces the repo-based liquidity infusion by a more durable instrument. So that is what they're doing. I would say that if they need to really address this issue, they need to allow the currency to find its real value or fair value, and intervene lesser, so that the drain on the liquidity because of this stable currency that you want to administer sort of comes off. So if you intervene as allow the currency to depreciate or find its fair value, then the drain on liquidity will also ease. So I think that's a more I would say reasonable strategy, rather than intervening and then infusing liquidity through OMOs, etc. So I think it doesn't help because you know continuous intervention in the currency market can actually translate into a enduring liquidity shortage.
Let me reframe the first part of my the first part question of the previous question, which
So
was about the credit deposit ratio. How do you think they will correct? Will there be a policy trigger for them to correct, or just the liquidity measures of the RBI would be enough for the CD ratios to correct over time?
So I think what the RBI's approach is appropriate. I would say that they have been actually using regulatory tightening measures to nudge the uh, nudge the banks to reduce exuberant lending. They have also been taking measures using moral suasions as well to curtail or monitor the NPA ratios in NPA or credit costs relating to retail lending as well. And the problem is that this is not we are at the onset of a retail credit default cycle, because if you look at it, the lending growth on the retail side, I would say both the banks and NBFCs and microfinance, and also I would say the rural lending has been far higher. I mean, far higher than the income growth. So it's in multiples. So I would say that RBI is aware of this. There's a possibility of an enduring NPS a credit cost cycle. So I would say that RBI has been utilizing some of its measures, regulatory measures at its disposal, and I would say that they should continue with that. I think they will continue. I think they know that, because otherwise it will have an impairment in the overall the capital base of the banking system, and it can actually translate into financial instability. So I think they have the right approach. Uh, so I would say that we can really look at. So the thing is, one thing definitely doesn't work is to really cut rates. It won't work, because you need to ensure that the banking system also works on stimulating or mobilizing deposits. I think the deputy governor recently made a statement that you can't have the banks have been relying a lot on bulk deposits of corporates and stuff. And I would say they are also saying that you can't rely on RBI all the time to fund your mismatches. So that's creating a ALM mismatch. And I said earlier, they're relying on the non-bank liabilities as well. So as a ratio of total deposit, it had gone up from 5% in the pre-COVID era to almost like 10%. So I would say that the overall leverage, leverage relative to the deposit, it has been significantly higher than what the banking system can sustain, which means that there has to be normalization, which I think RBI should continue to ensure going forward. I don't think they have a sort of a direct measure to get that happen very soon. So there is no directed lending mechanism in the current regime.
Then it was my last question. What kind of focus, how do you see corporate earnings growth in the coming 2 quarters and then the financial year?
So I would say that's an interesting thing. So if you look at Nifty earnings, EPS for instance, prior to COVID, it was averaging about 3.5-4% between 2014 to 2019. Towards the end, there was, I think 2018, there was a buoyancy, but average it's been very modest. If you look at post-COVID, the average earnings growth has been roughly about 18% CAGR. So there's a significant departure from the pre-COVID trend. So if we had to create a counterfactual trend based on what the trajectory was prior to the COVID, I mean, the current level of EPS or earnings would have happened, let's say in FY30. So what has happened is that because of there has been a significant advancement of profit accretion for corporates, across a lot of industries, banking, non-banking, especially I would say material space, and because of the bounties that were given by the government, tax cuts, etc., and also pricing, monopolistic pricing, etc. So I think companies had a significantly good time. Cash flows have improved dramatically. But if you look at last 1 year, I mean this year, average growth has been roughly about 4%. And I would say there has been at a broader level, if you look at non-finance companies, there's a contraction in profits. So I would say it is quite possible that there will be a normalization of profit cycle in the years to come. So I would say that you might actually see a very modest earnings growth in the years, maybe a couple of years. It will be a very modest earnings growth. I mean, that is why we are seeing the volatility in the markets, especially in the context where the risk-free rate has gone up and the market premium is shooting up because of global developments as well. And we are seeing, performance of companies undershooting the expectations. So there are earnings cuts that are happening in the consensus estimates and projections that analysts have.
Dhananjay Sinha, thank you very much for your insights and for your time.
Thank you very much.